Hello and welcome everyone. This is Binam from Banks and Markets. Today in this video, I would like to talk about some money making opportunities in 2023. Basically, I want to explore and debate if 2023 is a good year for investment in the stock market. So if you have views, comments, please do share. Now, this discussion is based on some predictions. When I say predictions, I would like to show you what people have said. So CNBC survey of many millionaire investors, it finds that the stocks will suffer big losses in 2023. Another is by Michael Burry. Michael Burry is someone who has remained pretty accurate about his forecast, his prediction, and he's saying 2023 will be a deep economic slowdown. Another by Charlie Munger, the business partner of Warren Buffett, and he is warning about spiraling inflation and recession in 2023. Similarly, Chamath Palihapitiya is also calling about a situation which is going to be worse than a recession. Now, with all these predictions, we want to talk and discuss if such a crash will allow us the opportunity to make money through investment in stocks in the year 2023. Now, do I believe in the predictions? Now, you see, I'm an academic, and although I do invest, my philosophy is that I prefer the conclusions that are evidence-based, that are scientific. Now, in terms of these predictions, I can agree to some extent because inflation is on the rise everywhere, and central banks, Fed, Bank of England, central banks around the world have been increasing the interest rates. But the economic growth is not taking same pace. In fact, economic growth has slowed down in many countries. So this does give some idea that the poor time in the economy can become is imminent, but how deep that will be and how long will such slowdown will continue will depend on a number of factors. But here in this video, we want to debate about if such a crash will allow us the opportunity to make money, number one, and number two, if the crash happens, then how someone who is busy, who is in a full-time job or some other commitments, can make money by making investments in stock markets. Basically, you are someone who do not want to pay the fees to wealth management or asset management companies. You want to do it yourself. And given the fact that there are so many trading platforms that are easily accessible, downloadable in your phone, it is not that tricky to make investment in stock markets, which then basically means you need to understand what the crashes are first, isn't it? So in terms of crashes, if you see what happened in 1987, Dow Jones Industrial Average, as shown in this chart, lost its value more than 500 points in a matter of one single trading days. After that, we saw the dot-com crash, and Nasdaq reached its lowest on the 7th of October 2002. We also observed a persistent and long slowdown in the economy, as well as deep in the index value, such as this one, S&P 500 index, reached its bottom on the October the 27th. A more recent market crash took place in the year 2020. In fact, March 23rd, 2020 was the date when the market hits its bottom. So we are here talking, if we were able to buy the stocks at this point and sell it when it is highest, okay, somewhere around February 23, 2021, which is less than a year after your investment in March 2020, your return, your investment value, in fact, would double. Can you see? That's 100% return, 88% in terms of price appreciation, 89.72 including dividend, and annual equivalent 100%. So that basically means to double your investment, you do not even need to wait a full 1 year. You just apply the buy low, sell high, the naive, easy to implement strategy, and make money that way. But then the question could be, how will you invest? Which stock to invest? What strategy to follow? So now I'm going to talk about those with the help of an illustration. But this video is mainly about the discussion, the type of debate I want to encourage. So I would really appreciate your comments if you think a contrarian approach can be applied to make money in stock markets in the year 2023. Now, in terms of where to invest, what strategy to apply, if you are a busy individual and you are not able to spare much time, then you may like to do something like this. So I'm just taking a randomly selected sample period. So I'm saying I will start in early 2017, I finish after 5 years in 2022. I just want to see how much will I earn. Okay, so I'm not saying I'm buying the stock when the stock prices are very low. I'm just taking this randomly. Okay, because here the purpose is to show you how you can devise a strategy, form a portfolio, and see what type of return you enjoy. Definitely, if you follow same or similar principles and buy the stocks when they are at the bottom of their prices, sell them when they are high, definitely it should be the case that you will be making money. But for the illustration purpose, what I have done here is I've done some learning, and this is what I would promote you do as well, because Warren Buffett's quote that I like is the one in which he says, the best investment one can make is an investment in yourself. The more you learn, the more you earn. So on the learning part, what I would like to say is you first need to find out which stocks to invest. And if you just type in Google something like this, which is what I have done, I just typed in top 100 richest companies in the world, and this gave me the list of the richest companies in the world. And then my strategy, a very naive, simple strategy, was to invest in blue chip companies because it's easy for everyone to understand. You can also implement some other strategies, such as you may say that I prefer regular dividend income, so therefore I'll be investing in companies that pays high dividend. So find out all the stocks from an index which is paying high dividend, in terms of yield and invest in those stocks. Or if you think of some other criteria such as high beta stocks, find out stocks that have high betas and so on. But here, just to make the life easy, I'm saying to you, you can apply this approach, which is invest in blue chip companies. Now, blue chip are generally those that have high market capitalization, well established, they've got some reputation and so on. So you found the list, but there are 100 of them. But you may say that, oh, 100 would be too many. But you don't want to lose the benefit of diversification. So how many will allow you to diversify adequately? And if you read journal articles, because I'm an academic, you see, and therefore I rely a lot on published papers. So Statman in 1987 is saying here about 30 stocks minimum is required to diversify the portfolio. So therefore, what I have done from those 100, I've only taken 30. But this 30 relates to the period January 27. So in January 27, these were the 30 richest companies. If you see now and compare, there's not big difference. So Apple, Microsoft, Alphabet, Amazon, they're all here. Apple, so you don't see Saudi Aramco because in 2017 perhaps they were not listed. But most other companies are still the same. Okay, so you've got these companies now. So in terms of which companies to invest, you have finalized this, or you may find some other criteria more appealing to you. Go with that criteria. After that, you want to find out how much to invest in each of these stocks. So you want to find out the weighting of your investment or percentage that you need to invest. So for that, if you are happy to assume that you should be investing more in richer companies, then what you can do is find out the market capitalization of all these companies, find out the total market capitalization of all the companies in your list. So that's this amount, which is the total of all of this. And then tell the computer to give you the proportion. So that's market capitalization of Apple divided by the total market capitalization of all the companies in your portfolio. That gives you 8.5%. Now, let's assume that you want to invest a small amount because this is the first time, let's say, you are investing. So you just want to, okay, $1,000 is the maximum that I can invest. Maybe you are a student, or you do not have spare money, or you don't want to take risk because it can be scary, let's say. Okay, so what happens then means 1,008.5%, $85 to be invested in Apple. So now, if you follow the same rule, then $33 in Google and 67 in Microsoft and so on. So ultimately, your total investment is 100%, which is here. Now, I have said this can be your strategy in terms of how much to invest, but you may want to switch to some other strategy, such as equally weighted strategy, in which case you will say, I've got 30 companies, I'll invest equally, so 1 over 30, that's 3.33. Or you may say rank investment, then based on the rank. Here, it's ranked in terms of the list of the rich companies. Okay, so that's what we have done. Now, after this, you can see here, these are just the share prices. And here on this side, I'm just finding the share price return. So very simple. These are monthly data. So monthly share price return is what I have found for each of these companies. Okay. And in terms of diversification, a fair amount of diversification has been achieved because, as you can see, firstly, there are companies from different sectors. And this is something I didn't dictate. I just took the top 30 companies, richest, and now I can see this is technology, communication, financial, energy sector, industrial, and funds and consumer. So there are 7 sectors. And in total, if you see GICS classification, there are only 12 sectors. So you 7 out of 12 in just the 30 companies. That's good. Now, also what I have done is just to ensure that I have enough diversification, I've also computed the correlation matrix, and you can see here that the red basically means highly correlated, but yellow and amber basically means weak correlation. Now, diversification is achieved when you have weaker correlation. There are more amber and yellow than red, which means the correlation matrix also shows you the fact that the stocks have more evidence of weaker correlation, i.e., the diversification to a large extent has been achieved. Now, after this, I now need to relate with my investment amount. And if we say that 1,000 US dollar is the investment that we can make, then we're simply saying here 1,000 times the investment percentage in Apple, which is 8.5. So that's 85 US dollar. So that's what we get here. Okay, and that's what I have copied across for all other companies. So this is what we get. Now, finally, the total amount of investment at the start is going to be 1,000, which is simply the addition of all these amount, which is in fact exactly 1,000 US dollar. So that's what we get here. And after this point, what we need to do is compute. So now what we have here is we can see here how the portfolio value changes. So basically we allow the portfolio to change the value as the share prices in the market changes. We do not do any kind of rebalancing because we're talking about an investor who is lazy, who doesn't want to get involved much. So first 1,000 US dollar has been invested, then the investor will only go back and see what has happened to the investment after 5 years. But here, periodic portfolio value has been captured, and therefore you can see that these are the monthly return. Okay, these are the monthly return. And in order to effectively compare or evaluate how the portfolio performed, I also have the data related to benchmark or the index values. So the index value is here. This belongs to DJIA index or Dow Jones Industrial Average Index. And I just need to find out the return, periodic return of this index. So that's what I am going to do here. And I just need the value next month divided by the value previous month minus 1, that is benchmark return. So I've got portfolio return, benchmark return, and I just double click. So I've got all of them. Now my job is to find out what did I earn as compared to the benchmark. So this is what I would like to see. What did I earn? So that's portfolio, that's benchmark or index. And what did I earn can be computed by, say, product 1 plus, because I'm interested to find out the geometric mean return. And this is a data for 60 months, 5 years. So that is going to give me the return, which is geometric mean monthly. Geometric mean annualized is what I can find out. So to find out the annualized one, I just need to do 1 plus rate of return power. This is monthly data. So 12 take away 1. So let me do this once again. Equal product 1 plus, and then I need to highlight all of these. Power 1 over n is 60, take away 1. So that's what I get. Before there was some mistake, and for the index it is this. So what I'm seeing here is I am getting a return, annualized return, which is almost which is 19.5%. So this is same as saying what is my compound annual growth rate, which is, if you think in terms of the value of the portfolio, 2,435 divided by this amount, power 1/5, which is 1/n, take away 1. So that's exactly what you get here, compound annual growth rate. Okay, you see here, compared to the index, you are 5% point, almost 5% point above. So that's a good outperformance, good outperformance. Now, of course, there are different ways of analyzing or evaluating the performance of this particular portfolio. And this is something I'll be showing you in my next video, where I will make use of a number of portfolio evaluation tools to help you and guide you effectively how this portfolio has performed. But for this video, firstly, really grateful for the time that you have spent listening my video. I would be grateful, very appreciative of your comments as to what you think about the contrarian approach. Can we make use of a strategy in which we would like to buy low, sell high, and can we make money through investment in stock market in the year 2023, given the predictions that I shared to you made by different wealthy investors around the world. Thank you very much for your time, and thank you very much for listening.